Welcome to another training here at Short Option Success. Today we're going to just start real basic. We're going to talk about why or how this strategy is different from other types of investing. And it is completely different, and you kind of have to wrap your head around the uniqueness of this type of strategy. Okay, so what do you do in a normal investment that you would do? What do you have to do? What's the first thing you do if you just make any kind of investment? I don't care if you're putting money in a savings account, you're going to get into the stock market, you're going to buy a piece of real estate, whatever the investment is. What do you have to do?
First, you got to fund, I guess, your account and look, research.
So research, of course, you got to figure out what you want to do. But then when you decide on that thing, whatever it is, you said it, what do you have to have?
Fund your account.
You have to have funds, right? You have to have the money to do it. So whatever it is, real estate, stock, if you get into the stock market, if you're going to buy and flip cars, whatever you're going to do, you first have to go pay for it. Pay for the investment. Whatever it is, the price of the stock, the price of the house, if you're buying a house. Now, you know, most people borrow money, but the fact remains, you find an investment, you find something you want to invest in, and you take the money out of your pocket and you buy that thing. Okay, so I'm going to buy this particular thing, and let's just say there's a chart, and right now, this could be, again, anything. This could be the stock market. This could be real estate market. The price fluctuates all the time, right? It moves along on a chart where you have price here and you have time here. So let's say today, right now, this point in time, we are going to pay for or buy this investment. So I take my money out of my pocket and I pay whatever that price is at this point. Okay, now time goes on, right? Time marches on. Things happen in the market, whether it be the real estate market, the car market, the stock market, whatever it is, things happen, fluctuations happen. And what can happen to that? There's three things that could possibly happen. The price can, well, that one doesn't work too good. We can differentiate blue. The price is either going to go up, price is going to come down, or the price is going to pretty much just hover right in the middle, right? Not much else that can happen, right? One of those three things. So what happens if you pay for this investment and the price just kind of stays the same? Is that a good thing for your investment? Not really. I mean, you're not losing money, but you know, you're not making any money either. And you've got all this money, whatever it is you're doing, you've got that money tied up that's basically not earning anything if the price just sits there, right? The second thing that can happen, the price could go up. Now, what's that going to do for your investment?
It depends.
Well, it can go good for your investment, right?
Right.
If I'm buying it here,
Yeah.
you've all heard the term buy low, sell high. Okay, so buy low, sell high. If the price goes up, then we will be making money as that price goes up. Now, the third thing that can happen, as we said, is the price could go down. So what happens to our investment if the price goes down? So we've got negative dollars, right? So we're losing money. All right. Point of it is, though, we could not be here without paying to get into this market. We had to pay whatever it is, the cost of the share price, the price of the real estate, whatever it was. We had to pay that price just to be able to get in and play in this game, right? 2 out of the 3 scenarios we're losing. 1 of them we're gaining, okay? And so we have to be correct about the fact that if we buy now, we think that price is going to go up. We have to be correct about that, okay? And again, it's only 1 out of 3 chances that we're going to win, that we're going to make money. Okay, that's every type of investment. not every type of investment, because we're going to talk about one that isn't this way, but it's majority, the vast majority of investments, this is how it works.
Yeah.
If you boil it all down, this is how it works.
Mhm.
Okay. All right. So let's take these away. And we'll keep the same chart right here. All right. And in this scenario, we're not going to pay, this marker needs to go. We're not going to pay for our investment. Okay. What we do is we sell options on the commodities market. And I'll explain how that works. So first of all, real quick definition of an option. An option gives us the right to either buy or sell something at a future date for a specified price with a limit on how long that time frame is that we have that right. Okay, and I'll explain that kind of as we go along. But let's just say this is again an asset. We use the same exact chart that we used before. This is the price chart of this asset, whatever this asset is. Well, with an option, it has a lifespan. So when time gets to this point out here, that option will expire. You either have to, if you buy that option, if we were to purchase an option on this, we could buy it back or sell it. Excuse me. If we buy it, we can sell it in the future to either make our profit, if there's a profit, or get out of the trade and take our loss, if that's the case, or we can just let it sit there, and if it does not hit our strike price, which I'll explain in just a second, then it expires worthless. It just goes away. Okay, so in the options market, generally, you don't get into the trade right where the price is today. Mm-hmm. So in an options market, we can get into this trade, and we can put on an option up here, or we can put on an option down below it, either way, because in the commodity options world, it doesn't matter which direction you go. It's just as easy to go to the upside as it is to go to the downside. Where this point is in relation to the price that the underlying security is, whether this is a stock or a commodity, where this price is that our option sits at is called the strike price. Okay, so let's just say right now at the money is 100, and we may be selling an option up here at, or either, we'll just say buying right now. We'll start with buying. Let's say that this is 150, and this is, I don't know, 65. Those are the prices. Okay. So we can get into those trades that are further away from the money. Now, why? You can get in an option right here, but it's just going to be, if you're buying, it's going to be extremely expensive. More expensive probably than makes it worthwhile.
Right.
But I can get it for cheaper here. So if I think the price of whatever this is going to increase, I can buy an option up here, and if that price then moves this direction, my value of my option, whatever I paid for it, is going to increase, and I can make money on it. Mm-hmm. In the same token, if I buy an option down here and the price begins to drop, the value of this option is going to increase. Whatever I paid for it, the price will increase, and I'll be in profit. Okay. Now you have to do a specialized kind of option. So if you're above the market and you think the price is going up from where it's at now, this is called a call option. And if you think the price is going to fall and you put an option on below the market, that's called a put option. Okay, you can remember that: call me up, or put me down. Okay, that's how you can remember. If you believe price is going up, call option. Price is going down, put option. Okay, all right. So if indeed I buy this option, this call option to the upside, and the price indeed goes up, the value of my option will increase. Now, at that point, I can either sell it and recoup and make a profit. That's fine. I can do that. Or I can hold on to it until later date. If I hold on to it and it does continue to track up, and all of a sudden this option is now what they call in the money, ITM, in the money, I can exercise that option and I can get into a futures position and I can make money in the futures position.
Mm-hmm.
So I have some options there. But in order to make money when you buy, you have to be right about the direction. Okay, if I'm buying a call, I have to be right about the direction.
Mm-hmm.
I have to be right about how far it will go, because remember, I'm up here to 150, so it's got to increase at least 50, or a good portion. Doesn't have to increase all that. You can make some money if it went up by $20 or $30. You can make some money and get rid of your option and pocket that profit. And you have to be right about how long it's going to take to do that move. So the timing. So when you're buying an option, you've got to be right about those three things. Which way is the market going to move? How far is it going to move? And how fast is it going to move? If you're right about those three things, absolutely you can make money. That's what draws millions and millions of people into the buying side of options. Okay. Conversely, on the put side, if I was to buy a put at this point down here at, say, a 65 strike price, if the price moved down, same scenario, it's moving in the direction that I predicted because I have a put, and I'm going to make money. Okay?
Mm-hmm.
Simple. Piece of cake. All right. So the question then comes in, what if I buy a call option, and instead of doing all this, it does that? Then what happens to my call option?
Negative.
It's going to decrease,
Yeah.
right? The value is going to decrease, so I'm going to be losing money on it. And every time it goes down, now it's got even further to go to get up towards my strike price.
Mm-hmm.
Okay? And to compound your problem, every day that goes by, you're getting closer and closer to this expiration.
Right. It's a lot of stress.
Exactly. This is called time value. Okay? So whatever you're paying, whatever amount of dollars you're paying for either of these options, neither one is in the money because the money is here. They're both what you would call out of the money options. And so the whole value that you are paying is comprised of what they call time value. So it basically says, I believe that in this 40 days, 50 days, 90 days, whatever this time frame is, I believe it's going to make the move that I think it's going to make. And I'm gladly paying for this much time value to see if that happens. Now, time value, I mean, there's nothing tangible there. It's not like you're buying a car or you're buying a house. There's nothing tangible there. It's just time value. If you think about a balloon. If I had a balloon, I could blow it up, and I'm holding that balloon and it's full of air. That's like time value. But every day, every day that time value shrinks. Every single day. And by the time you get out here to the expiration, the time value is gone. If it has not gotten to that strike price or this strike price, even if it's moved down a little bit and you don't do anything to get out of the trade, if you have a profitable option, it's going down, you've got to put, but it's not going down enough to really, you don't want to get out yet. You want to wait and see if it's going to get better. Mm-hmm. Well, if it doesn't continue down, then every day it goes flat or every day it goes up. From that point, you're going to begin to lose money off of whatever you could have made.
Right.
Right? Because again, time value is ticking by every day. When you're a buyer of options, time value is your enemy. It's your enemy because like I said, you got to be right about those three things: price direction, price magnitude, and timing. So every day that time value is working against that option buyer every single day. All right, so let's contrast that with what we do. We'll just leave that right there. We'll contrast that with what we do. So the last scenario was if you bought an option. Just like any normal investment, you have to take money out of your pocket, you pay whatever the value of that option is, which is called the premium, the option premium. You pay for that on the day that you get in the trade as a buyer. Now, what happens to that money you paid in? Let's say this option up here had a price at the day you got in of $300. Let's just, okay, that was the price on that day. So you would take $300 out of your pocket and you pay for that option. So then what happens to that $300? Anybody have a thought?
It's in the market, I guess it's in,
okay.
In the trade.
90% of people, 99% of people out there probably don't know.
Yeah.
Okay. What happens to that money is that money goes in my pocket. If I'm selling that option, every transaction has to have a buyer and a seller. You can't go to the really nice house in your neighborhood down the street and just say, well, I'm going to buy that. If the seller doesn't want to sell it to you, you're not buying that house, right? So every transaction's got to have a buyer and a seller. So the buyer wants to buy this option, and if I do my research and I think that's a good, this would be a good investment decision for me to make, then I'm going to sell that option, and whatever money the buyer paid, minus a little bit, a commission fee and, a few little fees, but they don't amount to hardly anything. But that money essentially is going to go right into my pocket. So when I put a trade on, in the strategy that we do, I don't take money out of my pocket. I don't have to reach in my pocket to get in this trade. I just have to say, I want to sell that. Well, Tom, how can you sell something that you don't own? I mean, most people ask me that question, and it's magic. No, you can literally sell something that you don't own and get paid for it. Okay, and I'll explain how that is possible here in just a second. But just for right now, just understand that when I get in this trade, this 150 strike price call is, there's a buyer, there's a seller, they come together, the transaction is completed. Okay, he pays $300 to buy it, I receive $300 when I sell it. And we've created an open contract on that strike price. All the exchange does, whichever brokerage or exchange you're with, all it does is match up buyers and sellers. They don't actually buy or sell anything. They just bring buyers and sellers together. Okay, so the buyer buys it, I sell it, he pays $300, I collect $300. So I have not taken anything out of my pocket for this investment. All right, now what could happen as we move forward in this trade? Well, the same thing could happen in for the buyer, right? Same thing can happen. The price can go up, the price can kind of hang out in the middle, the price can go down, right? That's essentially all that can happen. So what happens? Let's look at these three things. And let's just say, for the sake of example, let's say I also sold one down here. And let's say down here I collected, I don't know, $250 for this one. Okay, so I sold one put down below the market. I sold one call up above the market. And combination, I received $550. So I'm up $550 when I start that trade. Money actually literally comes into my trading account. Okay, so I've got these two trades on, and again, one of these three scenarios will take place. All right, so let's just say if the market moves up. Well, just like we said before, if the market begins to move up, it's going against my position here, right? Because the price of this option will rise because they were correct. It's a call option. Price is moving up. Okay. So the buyer's pretty happy at this point. And unless this price doubles to $600 in value, I'm not too worried about it. I'm going to let, if that price is moving up a little bit, the price is moving up. If it goes to $350 or $400, I'm not too worried about it. Okay. Now, if it gets to $600, then I've got to do something. I'm either going to get out of the trade, I'm going to do some form of management of that trade. But we've got a pretty good amount of movement that we can tolerate before we've got to do anything here. Okay? Now, you look at this chart back here, this is really more like how charts work. It hardly ever moves in a straight line. It doesn't move in a straight line. Even if it's going up, it's going to have jogs in it, right? So I know that even if it's moving up right now, chances are it's going to correct. It's going to move down. It's all this price moving is the what they call the bulls and the bears, which is the bulls are people that think the price should be higher. The bears are people that think the price should be lower. And every trading day, they're fighting. They're fighting, and whoever wins that fight, it either goes up or down. That's how it works. Okay, so it can go up. I'm not worried about it. Let's look at this other scenario. What if it goes just kind of flat across here? Okay, if you were a option buyer, it would not be good for you, right?
Yeah.
Well, what if you're an option seller? Still good. It's good for you. Why is it good for you?
Because you're not getting anywhere close to where you're at.
Yeah, it's not moving towards either strike price. It's just in the middle, kind of hanging out. You know, it's going to bump up and down. That's called a kind of a narrow sideways channel where it's just moving along. Well, what else is happening there? Time value is going away every single day. So every day that it just kind of hangs out here in the middle, time value is starting to erode. Because remember, again, we said this whole price is based on the time value. There's no tangible thing there. It's just time value. That's all the value of those options is. So I received 300. That's what the time value was as of the day I put that on. Well, if the price just kind of hangs out in the middle, it's not getting any closer to my strike, but less days are now available for it to get to my strike. That time value is going to get smaller and smaller and smaller. So the value of this option is going to start to fall. The nice thing is, if I was the buyer of either of these options, it would have to move in that one direction for really a pronounced period of time for me to make money. If it's in the middle, the buyer does not make anything because he's losing time value. But if it's in the middle for us, we're making money because the value of those options is falling. I said that time value was the enemy of the buyer. Well, time value is our best friend. Well, if we could take them to dinner every day, we would do it. Time value is what we make our profit on. Okay, so if it's just hanging in the middle, not doing much, time value is eroding. The value of these options is dropping, which is what we want as sellers. And that'll become more clear in just a second. But now remember, we did two here. So let's go back to that first scenario. The price is going up. If the price is going up, and so the price of this top one is getting higher, which is going against our position, what's happening to the price of this one down here while that's going on?
So it's increasing.
No, this one's decreasing because the price is moving further and further away from this strike price. So even though this one we're losing a little bit of money on as that price increases, this one we're making money on because this price is decreasing. Because, and I'm talking about if the price is moving up. So if the price is moving up, it's getting further and further away from this strike price. And days are still ticking by. So less time value, less chance for it to reverse and not only go from the price today to the strike price, but now it's got to go from way up here to the strike price. So it's got to further travel, further way to go in less days now. Price is falling.
Yeah, okay. And then that reverses it for the call right there, right?
Right. The call is losing a little money because it's moving up. The put is gaining money because the price price is further and further away from it. Okay, so what can happen then? Let's just say the price moves up like this. Man, that option buyer is happy. We're watching our position. We're not worried about it. It's, you know, we're a little bit in the red on that position. We're okay, as long as it hasn't doubled. And then all of a sudden, so it moves up, and then all of a sudden, it kind of breaks down a little bit. Okay, well, now this one is going to start to fall in price. The option buyer is going to kick himself for not getting out right there. But it's starting to fall. And again, more and more days are getting used up. More and more time value is getting eroded. And it's moving away from our strike price. So the value of that option is falling again. Now the value of this one on a down move, it might kick up a little bit, but it's still a long way away from our strike price. And this is essentially what happens in markets. Markets move up, markets move down. I mean, that's what they do. So most of the time we'll position ourselves on both sides of the market. And even if something extreme happens, even if this thing goes like a rocket up there and it gets to that $600 mark, I'm out of the trade. I'm done. Now, I don't necessarily buy it back. I might roll it to a higher strike up here. You know, there's a lot of management. We're not going to get into that today. There's a lot of ways to manage that. But if it shoots off like that, and this one turned out to be not a great trade, that's fine. We'll do something with it. Okay. But what's happening here?
It's increasing that value.
This one, the value's dropping like a rock.
Well, I mean,
our profit is increasing,
profit,
but the value of it's dropping. Okay, so in this scenario, let's say worst case, I got two options on here, and let's say it goes against this one up here, and it gets to that $600, and let's just say I buy it back. So I received 300, I paid out 600, so I would have a loss at that point of $300 on that trade. Okay, now market can only move one direction at a time, right? So as it's moving against this one and I'm taking a loss there, this one, the value is falling, my profit is increasing. And so at the end of the day, I collected 250 on this one. So I win this trade, I lose this trade. Now overall, that's a losing pair because I lost $50. I made 250, lost 300. However, that's another reason why we do it on both sides. If I just had the call, then I would have lost $300 on that trade. If I just had the put, I wouldn't. In this scenario, I would have made 250, and that would have been it. But by the combination of the two helps us to mitigate risk. And what happens in the majority of times, 80 to 85% of the time, even if the market moves up, it settles back. It might even come down a little bit. It usually settles back. And at the end of the day, it never gets anywhere near these two strike prices. So about 80% of the time, both of those options expire worthless, and we've made this $550. It was put in our account the day we sold those options. Then we monitored it, we watched it, we managed it if we had to, and we let time erode every day. 80% of the time it expires worthless, and we keep both premiums. And that's how we make money. Now, I said before, remember some people ask, well, how can you sell something that you don't own? All right, so we're really not selling something we don't own. What we're doing is we're completing that transaction. Like I said before, the old adage, buy low, sell high, right? So what we're doing is we're just reversing that order. We're selling high at 550, and we're hoping that they get to zero in value. So we don't have to actually buy it, but if you want to say that our buy equals zero, so we've sold high and bought low. A buyer has to buy low and hopefully sell high. We're selling at the high point and we're hoping to buy it back. And even if at some point along the way, we decide we want to get out of that trade, and we've already collected 80 or 85% of our, it's already profit at that point because of the value change in these options. Fine, maybe we've got to buy this back at, instead of $550, maybe we can buy them both back at $75. A heck of a trade.
Yes.
And we can save ourselves some time, then turn around, redeploy that money and do some more trades.
Mm-hmm.
Okay. So in a nutshell, that's how it works and how it's different than the vast majority of investments where you have to pay something and hope the value goes up. We are receiving money on the front end. We're just hoping that the value just kind of dwindles as time goes on. It maybe make a little move up, a little move down, whatever, but it's, for the most part, it's just kind of bouncing around in there. And once that time expires, the money is locked in our account. Nobody can ever take it from us. It's profit. Okay. Any questions about anything we've got here? I know this is a beautiful
piece of art.
That's right.
I do have a quick question. Earlier you mentioned in the money. What is considered in the money?
Okay. So our option is based on the price that we put it at. Okay. So this is in the money today. That's where the value of that stock or that commodity or whatever it is.
Okay.
This is in the money. So this option is considered out of the money, right? And this option is out of the money. But if the price were to move up and all of a sudden get up here, exceeding, if it got up there even to our strike price, it would be considered at the money. And then if it exceeds our strike price, then our option is in the money. And we don't want to be at the money or in the money. We always want to be out of the money. Preferably pretty far out of the money. But great question.
So in the money is the current value of it.
Well, so in the money just means if I sold an option at 100, I would be selling one at the money.
Okay, because it's an even wash.
Right.
Because that's the value and we sold it right there.
Where our strike price is.
Versus.
But if this price goes up to 150, then all of a sudden this option is at the money. If it goes to 160, then I'm in the money. The price is higher than my call option. I'm in the money. If the price comes lower than my put option, I'm in the money.
Okay.
And we do not want to be there.
We want to get out of the money.
Yeah, we stay out of the money. But great question. All right. Anything else? All right. Very good. All right. Well, that's all we got for today. And we will, you guys watching this on YouTube, if you have any questions, just put them in the question section there, comments, whatever, and we'll do our best to get them answered for you. All right. Thanks for watching. Bye.